Hey folks, glad you could join us on another episode of Business Redefined. We have been heavy on public finance because of the season. We want to switch matters and talk a little bit about banking, and we want to talk to the head of personal and private banking at Stanbic Bank, that is Mr. Abraham Ongenge. Karibu sana.
Thank you very much, Julian. And
glad to be here, man.
Viewers.
Asante sana. We will be focusing a lot on the retail side of the banking sector. So this is a conversation for you and I as ordinary citizens. Abraham, asante sana. Let's start from here. There has been a lot of conversation in the market around the credit risk environment we are in. The CBK had its meeting not too far back where they cut their rates again. We have seen NPLs ticking upwards, telling us the credit risk in the market is a bit elevated. In an environment where you are chasing the retail market like you are, how do you calibrate your risk here?
Thanks very much for that question. So there are actually two aspects to this. So we are seeing an increase in NPLs based on the data that we have. But one of the things that's positive is that we're also seeing a turnaround in private sector credit growth. So latest numbers show about 2% up. This number was negative when we went to the tail end of last year. It then means that banks are actually now becoming a little bit more proactive in how they recalibrate their risk. And one of the things that's really helping, especially for us, is personalizing our understanding of our customers, widening the base in which we can offer credit solutions for our customers, right from simple 1-month type solutions to 5-year to 10-year type solutions. So a better understanding of your customers then enables you solution better for them. So that's how we are thinking about risk going forward.
I see. And I always think you're a man with a tough job. And let me explain. For a bank that has traditionally been known to be very niched corporate and investment banking, here you are trying to recast the brand towards a retail focus, something that falls squarely on your desk. How do you navigate that sort of switch, and how is the market's reception around it?
Yeah, and I think it's important to kind of appreciate the history of banks entering into the Kenyan market, which is largely been the way banks have actually thought about when they get into market. So they've always started with a corporate, maybe a representative office, start with a corporate structure serving corporate clients, then move into the retail banking space. Now, traditionally, for you to be able to move into the retail banking space, there were capabilities that you needed to have. One of the most known capabilities that you needed branch presence.
Yes.
But the future of the retail customer has changed significantly, and we have seen increased adoption of digital capabilities across. That then brings a strong business case on how traditional corporate banks then can move quite swiftly into the retail market, because we have the right foundation in terms of infrastructure to then leverage digital capabilities, and also the customer need to do a lot more in a digital way. So there's a strong business case for us to then say we can compete quite effectively and offer solutions for our customers, because our customers have changed. They no longer are traditionally based from a branch perspective. They are more digitally savvy. I think the realization also that the build of our ecosystem allows us to build on the trust that we've had, especially serving our corporate customers, into bringing that down into the retail space. There's definitely a need for us to be more relevant and engage the community. So financial inclusion becomes a critical enablement for Stanbic Bank to really be a Kenyan bank. You cannot address that without addressing the retail market. So that becomes then our path towards how we grow the retail space.
But Abraham, you cannot really wish away the fact that the traditional retail market is so branch-centric. And even as you speak about an evolving nature of distributional models around banking towards digital, there is the fact that a huge bulk of this segment of the market still wants a face-to-face interaction with a bank executive to address their needs.
Yeah, I mean, and you're right. I always say the important currency of banking is trust.
Yeah.
And a lot of how trust is built, it's built by people, first of all, seeing and hence why traditional presence, physical presence, still becomes critical in building trust. The understanding we do need to have around the role of the points of representation then changes. So there will still be some element and relevance around building branch presence in our retail journey and growth in our retail journey, but the structure of those branches are going to look very, very different. We believe that branches are going to become more relevant around the areas of community engagement. So using our points of representation to engage the communities, whether it is within financial literacy, whether it's within creating opportunity even for financial inclusion. We believe branches will still continue to be relevant for our complex lending type conversations where our customers are coming for much more advisory play. We have made almost all our branches 24-hour open branches, just to allow our customers to still be able to deal cash transactions without necessarily needing the human interface, because we are aligning ourselves to the fact that the community is becoming more and more adaptive to a 24-hour economy. The nature of the branches also would move more to be experience centers, where we then demonstrate our capabilities, we personalize our interactions with our customers going forward. But we will target those to the areas where we believe we can be more relevant to the customers.
I see. Abraham, my next question has two legs. The first one is this. The retail market in this country, and you know this better than I do, has got fairly strong incumbents. And I wonder, as Stanbic Bank seeks to elbow its way into that space and cement its presence, how do you deal with that fact? Because it's something which you cannot say you won't consider. It's a market reality.
It's a market reality, and how Stanbic then thinks about this is to say that excellence is important for us. So in addressing the retail market, we have to sequence our approach in addressing the retail market. One is, first of all, we believe that we've set up very good foundations around how we sequence our growth and scale into the retail market. We have set up a foundation that kind of starts building the customer of tomorrow and building financial inclusion. So people who are unbanked before, supporting them through a foundation structure, will start building those. But within the banking space, we want to sequence it by, first of all, serving our affluent clients. And last year, we did launch our proposition around affluent, where we looked at differently around our value proposition for affluent clients, largely around how do we think about assisting our customers in their planning, how do we assist our customers in their investment needs, their banking and transactional needs, but also how do we assist our customers live joyfully in a way. Most of our customers right now require a trusted financial partner and not just a bank. We believe we have the right infrastructure to kind of build on that foundation. We would then go lower into the market after we've validated our areas of strength and our dominance. It's quite pleasing that from a recognition perspective, we continue to be recognized as the #1 private bank by Global Finance. And it's quite pleasing that we are now creating that validation and allows us to sequence it more to the lower segments as we continue to grow, appreciating that we have other market players who have a much broader client base.
And the second leg to that question, and that is why that one had to be the first leg, is this. Based on your response, it sounds to me that even as you angle for the retail market, you will still be considerably niche focused and not just go for the mass market retail, if I could call it.
Yeah, so we will serve the mass retail market quite differently. And that's why we appreciate the power of our digital capabilities. So we will invite anyone who has the ambition to grow That's the kind of client we are looking for. That any client who has ambition to grow, welcome into our space. We will coin our solutions for that ambition, realizing that a big chunk of that mass market would also require financial inclusion. And that's why our capabilities around our foundations are critical, because they then nurture that invitation for ambition. So at the moment, our key area of dominance and our key area of strengths remain within the middle market, so not the mass market, the middle market area, and also the affluent space.
All right. And what's your strategy around product development for the retail market? And why I ask that question is because the feedback we receive overwhelmingly from the public is, whereas we have seen banks try to recast themselves into retail focus, it looks like their product development is still fashioned in a manner that targets a particular segment of the market, not appreciating that there are nuances in the retail market which are very different in terms of the product needs. How do you go about that?
Yeah, we've actually transitioned quite heavily to what we would call the segment of one. And what that means is that our approach in how we think about products is that we are converging more to personalize the experience of our customers. We would have to leverage machine learning and AI to achieve that. And if you think about lending as an example, for some of our clients, we do have offers for them right from 1 month product into 10-year product on the basis of how we have thought about their own affordability. For some clients, we do offer lending solutions, either secured or unsecured, because of where we think they are in their lifestyle journeys. For some of them, because of risk, the way we serve them becomes different. So for some of our customers, we would encourage personalized face-to-face because of where they are in their digital education. For some of them, we will just tell them, look, you are good for digital. So the way we then serve our customers differently for us is to hyper-personalize the experience going forward. And capabilities such as AI and machine learning are assisting us to do that.
Okay. The retail market, from what we see from the reports we see from the Bankers Association, the Central Bank of Kenya, is the market that I would say exhibits the most price sensitivity. If you have interest rates ratcheting up like we had last year, you have the most noise coming from this. And you understand why. Abraham, I'm wondering how you view the bank within that context, and broadly speaking, within the interest rate environment that we are now playing in as a market.
Yeah, I'll go back to one of the elements of banking, and that is trust. Yeah. Trust is always derived by how banks then address the customer need and empathize with the customer through these cycles. And sometimes the more you understand your customer, the more you appreciate their journey, the more you are able to solution. So if I think about where we are right now, there are a couple of things that have impacted our customers. One is significant decrease in disposable income, especially on the salaried segment, where we had to accommodate various taxes that were introduced last year. High interest rates, which then mean a high payout ratio for customers for the lending that they had taken. These customers, understanding them correctly, would allow you to get a very informed judgment around their character, and therefore your ability to structure them through the cycle of high interest rates. Hence why we have broadened our product solutioning. One of the things that has become quite topical is how we think about tenor for our customers. Yeah. Are you able to allow your customers more time to service their debt? And that's a critical option we give our customers. The other is, how do you do risk mitigation? And in supporting the view of our customers owning homes, partnerships with Kenya Mortgage Refinance Company, as an example, does two things. It first of all fixes the rate of payment through interest rate, and it also addresses tenor to reduce the quantum of pay. These are designed to kind of answer that question of customers around how do you support them through the cycle. The third is, how do we leverage our corporate partnerships in offering holistic financial solutions where the corporate can support their employee for their lending needs. So we do have value propositions that we then bring to our corporate employees and say, we are very good at assessing risk from a credit perspective. You want to put a value proposition for your customers in terms of lending. Can we structure something which you support? Either you risk share or you provide some form of liquidity, then we can be able to make that product affordable. So a myriad of things, the thinkings that we are having to ensure that our customers can go through these cycles. We are now in a better cycle where interest rates are going down, so therefore much more comfort.
It stays.
Much more comfort for our customers.
I know that. Something you touched on which is very important, especially in contemporary banking, and that is the role of deploying AI, one, in your credit risk assessment, in risk mitigation once it materializes. Just speak to us about how that is shaping the banking sector and also specifically what Stanbic is doing around this.
Yeah, so there are particular areas where we are leveraging new technology. One obvious area is our lending, our ability to react and provide appropriate lending structures, because we also want to be responsible lenders. So that's one area where we are doing that. And there are various things that we look at, and we leverage a lot of external data and internal data to make those decisions. There's a piece around risk mitigation, and risk mitigation enables us to anticipate the transaction patterns for our customers and highlight areas where we are seeing heightened risk. What we've seen in the industry, certainly because of the economic pressures we've had, is an increase in social engineering incidences where our customers are being compromised because of either giving up some of their secret pins and information. So we are now leveraging new technology to anticipate our customer patterns, and therefore ability to react and call back the customer and say, this looks strange. I can see you transacting in the Bahamas. This is your first time to be in the Bahamas. Are you sure you've gotten a holiday in the Bahamas? Sometimes it's true. Sometimes we do need to react and protect our customer wealth. Then third is also to anticipate opportunity. So a lot of our customers in their lifestyle transitions will probably be at a stage where they now need to start investing. So our ability to then reach out to those customers and say, based on where you are at, is a home of interest to you? Do you think you need to take a little bit more insurance given where you are? What about your children? Is there something we can do about your children? A holistic approach that then says, here is a partner who not only responds to you when you react, but a partner who also is upfront to tell you, could this interest you? And not necessarily just a product push, but really an informed conversation with our clients.
So if I hear you right, Abraham, is the deployment is really across multiple areas in the banking space, whether it is risk mitigation as well as tapping some opportunity as well.
Yeah.
And to what extent does the fact that you are really going hard for the retail market help you then build a further pipeline? Because remember, we've been in the season where there's a conversation about it's all under one roof. Whether you want mainstream banking services, whether you want wealth management, whether you want investment banking, it's all under one roof. How does this now play into that strategy broadly?
It plays quite strongly. It first of all starts with the trust that we've had over years that our corporate and investment banking team has had. Remember, these are organizations that are being run by people. So it starts in starting for us to integrate that ecosystem, that we can leverage on that partnership, we can leverage on that infrastructure to start moving to be the main bank for the ecosystem of our corporate customers. It also starts to create new markets where we can test, based on the data that we have around customer behavior, we can test new markets and start lending to people who probably never accessed lending before. Then third, it also creates an opportunity for us to kind of start building a sustainable organization, to start leveraging some of our liquidity capabilities as banks to promote a much better society. A key example on this is that we are quite strong in the mortgage market as a bank. But one of the things we've realized is that a lot of our customers, when they come to us, it is very easy for them to get a mortgage. But one of their biggest worries is that once you own a home, you then have to pay electricity, you have to pay for water. And we've thought, look, how can we combine our mortgage capability with financing green energy? Yeah. So combined with our corporate clients, we are able to then say our mortgage facility comes with some solar financing, ensuring that the customer can actually feel that this whole decision of owning a home actually reduces their running expenses. So building that sustainability also becomes key.
I see. Abraham, every other bank I've spoken to, whether in Kenya or outside Kenya, is having a conversation about the future client. A much younger demographic, more nuanced needs in terms of their banking solutions. Unlike we who are now the millennials and how we approach banking, they have very different needs and they want them served in a different way. How do you position yourselves as a bank to be able to cater to their needs?
Okay. And it requires us to, first of all, kind of start thinking, what's our thinking around the future retail customer? One of the things that's obvious is that they will be digital savvy. Okay. The other thing that's obvious is that they do have security concerns around their own data and their privacy. The third, they are very sensitive to sustainability and social issues. Fourth is that their income streams are scattered.
Yes.
So they
unpredictable.
And unpredictable. So they do many things and quite exciting, I would say. But they do many things. Now, when you start mapping,
are they as bankable?
Second is that they are bankable. They are bankable, but you do need to understand the risk pockets of their banking journey. So you do need to understand their risk so that you're able to solution them effectively. Now, if you map those pockets, we've then created foundations for that future banker. One, we've invested a lot around data privacy. Yeah. To say, when you come to us, the one thing we then assure you is protection of your own information. There's a lot that banks have in terms of data of people. The assurance they want to know is that you're only using that data for the purpose that it was granted and it was entrusted to you as a bank. Secondly, we have to understand those income streams. And we also have to simplify the process in which someone can access liquidity. We've attempted that. In the recent Think Business Awards, one of the things that Stanbic was recognized for is the best bank to borrow from. Yeah. Particularly, the one highlight that came out of this is that our ability to actually do a no-paper digital lending proposition, not only for the 1 month short-term ones, but even for a 5-year loan. Yeah. Based on our understanding of the customer, because we are starting to understand the customer of the future to say, when you will need that liquidity, you will not have time to walk to a branch.
Yes.
That is the future youth customer. They will want to say, I can go to the mobile, pick the liquidity I need, and probably do my business. The second piece is how we think about collateral, and saying traditional methods of collateral was bring me your car, bring me your title deed, let me see your house, and to say where are these people putting their wealth, and most of them are putting their wealth in treasury bills and treasury bonds.
Or stable coins.
Yeah, or stable coins. Now we don't have regulation yet for banks to kind of deal with digital currency, but it allows us to kind of think about this is where you are placing your wealth. This wealth can be leveraged to help you access more liquidity to do more things. So we've mapped out those characteristics and said what are the foundations we need to put in place to deal with this future customer. Digital enhancements continues to be something that has to be ongoing, including writing minutes with the customers using Copilot.
Yes.
Yeah.
Okay. My final question is a trick question.
Okay.
If I could put it that way. You are on a mission to scale the bank's retail footprint. You can do this organically, as you are. You can do this inorganically. And by sheer chance, you're at a sweet spot where the market regulator has decided to bump up the core capital regulations. If you look at the market, there are some strong tier 2, tier 3 entities with a good retail franchise. Would there be opportunity there?
I mean, I'm on a mission. The mission itself is also guided by my shareholders, and therefore it's probably a conversation that will be reserved to the shareholders. But having said that, my mission is focused on creating the capabilities of the current Stanbic Bank platform with the team that we have, to say, can we put a strong case for the customers sitting across the banking sector to say, choose us. So that would almost be an organic play for me for now.
We've been having a conversation with Mr. Abraham Ongenge, the man in charge of retail banking at Stanbic Bank, running through a raft of issues, including the state of the market from a credit risk perspective and whether the bank is well positioned to take more appetite on that side. We shall keep tabs on this, especially as Q3 numbers begin rolling, so stay tuned to Business Redefined.